US bonds continue their aggressive decline and the US dollar hits a fresh 3-year low as the Fed paints a confident picture on the outlook for growth and inflation. The January FOMC statement was not expected to shift market sentiment much, being Janet Yellen's last meeting as chair before Jerome Powell takes over in March. However, the Fed's message was clear. Employment, household spending, and business fixed investment was described as sound. The Fed was also more confident that inflation is expected to move up this year. US bond yields finished 2017 at 2.4%. Last night, they hit a high of 2.78%. That's the highest since early 2014. Now, normally, such an aggressive rise in US yields would benefit the US dollar. That's clearly not been the case. Indeed, the US dollar saw its worst decline in January this year since 1987, and that follows a 10% decline last year too. That's despite a more upbeat Fed statement and an optimistic State of the Union address from US President Trump that saw a $1.5 trillion infrastructure package announced. Now, clearly, there are a number of factors weighing on the US dollar at the moment. The confusion created by US Treasury Secretary Mnuchin in Davos the week before last, where he suggested that a weaker US dollar was good for the US, has certainly not helped. A sense that we may see rolling government shutdowns ahead of the midterms later this year has certainly been another factor too. The ECB recently painted a picture of a robust pace of economic expansion in Europe, which has helped the euro to fresh year highs above 125. The weak US dollar has been a key driver for the strength of the Australian dollar so far this year. Solid commodity prices have helped, with iron ore, for instance, above $72, and a strong run of economic data has also supported the currency. However, this week's fourth quarter inflation report was a strong reminder that Australia remains trapped in a low inflation environment. Yet again, inflation came in below the RBA's band and economists' forecasts. It's likely that the RBA will again emphasize that an appreciating exchange rate would be expected to result in a slower pickup in economic activity and inflation at the RBA meeting on Tuesday next week. This message should again appear in the statement on monetary policy on Friday as well. Now, Westpac is forecasting no change in monetary policy from the Reserve Bank of Australia this year and next. Combined with our forecast of 3 interest rate hikes from the Fed this year, that should see the Australia-US bond yield spread continuing to narrow. The spread between Australia and US 10-year bond yields is approaching zero. This is a factor that could weigh on the Australian dollar, and we expect to see some further weakness below 80 cents next week. Over and above the RBA policy statement on Tuesday and statement of monetary policy on Friday, we have December retail sales and December merchandise trade data on Tuesday as well. Now, after the strong November retail sales data, arguably boosted by iPhone X and Black Friday Monday sales potentially brought activity forward, we expect to see some give back in the December data. In the case of merchandise exports, though, we expect to see a pickup after record iron ore exports likely boosted receipts. It's a busy week next week for other central banks too. Thursday sees the RBNZ monetary policy statement and the Bank of England quarterly inflation report. ECB Governor Draghi presents to European Parliament on Monday too. And with the FOMC meeting out the way, we expect a steady stream of Fed speakers through next week too. These are all factors we can talk about in next week's Markets Update.